Hey everyone, I've got some great news for ServiceNow stock investors as the company's financial performance in the latest quarter exceeded all expectations. I'll go over those highlights in this video. I'll also update my buy recommendation for ServiceNow stock. I'll let you know if I think at current prices the stock is a buy, hold, or a sell. So let's get into the great news first.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so ServiceNow CFO said that we surpassed all of our top line and profitability guidance metrics for the quarter. Surpassed all of them, with generative AI conversations serving as the digital transformation catalyst. And even more good news, we see that momentum carrying into the second quarter. So not only was the first quarter much better than expected, but we see that momentum carrying into the second quarter. This was exciting and surprising to me because one of its competitors, UiPath, highlighted that they saw momentum kind of slow down throughout the quarter. So they started off really strong, but the momentum cooled down throughout the quarter. But ServiceNow saying that they started off strong and that momentum continued throughout the quarter. So it seems like ServiceNow competed effectively and contained and won a lot of contracts that maybe UiPath was also trying to obtain. RPO, which stands for Remaining Performance Obligations, ended the quarter at approximately $17.7 billion, representing 27% growth. Now, RPO, Remaining Performance Obligations, is where contracts go in first. For instance, if ServiceNow signs a 10-year, $100 million contract, that goes into RPO. It doesn't go into revenue. It first goes into RPO, Remaining Performance Obligations. And then every month, that money gets drawn down from RPO into revenue. Okay, so if it's $100 million for 10 years, that's 120 months. That 10 million gets divided into 120, and every month, that portion from RPO goes into revenue. So that's why RPO is so important. Eventually, it turns into revenue. And if RPO is growing faster than revenue, which is what happened with ServiceNow in the latest quarter, 27% RPO, whereas revenue was in the lower 20% range, 24.5%. That means there's upward momentum for revenue growth. Revenue growth is lifting or trending higher. That's what I like to see. I really like to see that with companies that have these types of sales contracts for RPOs to be rising ahead of revenue. That signals revenue is accelerating instead of the other side of the equation. The other thing that could happen, which is RPO below revenue growth, which would mean that revenue growth is trending downward. So this is the opposite. This is good news. This is what investors like to see from ServiceNow. So they continue to see average contract terms increase year over year as the strategic importance of the Now platform has driven longer duration deals. Another sign of effectiveness, ServiceNow demonstrating the importance of its offerings, and that's leading to longer contract terms. Their counterparts or their customers, instead of saying, oh, let's just try this out for a month or two, nowadays, more so, they're looking to lock it in, extending the contract terms, trying to say, we want these terms longer term. We find the good value in the terms that you're offering, so we want to lock it in for, 5 years, 6 years, 10 years. Whatever the case might be, we want to lock it in longer than we previously were interested in locking it in. Again, that's evidence that the company is delivering a good return on investment, because otherwise customers would not want to extend these contract terms. They like what they're getting from ServiceNow, and they feel confident that it's the best in class, and they're extending the terms. If they didn't like what they were getting and they didn't feel great about it, they would do more shorter term deals and look for another option. They would say, all right, let's just have this, for the next month or the next 2 months while we go search for something else. That's not what was happening. That's not what they're saying was happening. They're getting longer terms. So again, another point, another evidence of good signs of customer value proposition from ServiceNow. Additionally, their renewal rate was a best-in-class 98%, as the Now platform remains a strategic imperative for our customers' operations. That's a great number. 98% of the customers are renewing. That means only 2 out of 100 are not renewing ServiceNow. And those 2 out of 100, that small number means that the performance again is great, because those 2 are likely for reasons not associated with ServiceNow. Those 2 could be reasons for those specific businesses. They might be facing difficulty where they need to cut costs, and so that's why they did not renew, because they were in a dire situation and they had to cut everything down to the bare bones and cancel even a service that brings a good return on investment. They still needed to cancel it because they needed to get down to the bare bones. That's what you get when you have a 98% renewal rate. So ServiceNow now has 1,933 customers that are paying them over $1 million per year. And in their contracts, generative AI products were 7 out of the top 10 deals. So their generative AI products are increasingly popular with customers. They were incorporated in 7 out of their top 10 deals, and their generative AI is leading to new contract wins for ServiceNow. Now, looking at the company's specific financial performance, these were truly excellent. Free cash flow margin of 47% is really strong, and that was up 12% year over year. This is among the leaders of every business in the world, 47%. It's among the leaders, the top of the top, free cash flow margin of 47%. Their balance sheet is absolutely pristine with $8.8 billion cash and equivalents. And in Q1, they bought back 225,000 shares. And the reason they're buying their shares is because they're using a lot of stock-based compensation, which is a non-cash expense, so it makes its free cash flow look great, but it also dilutes shareholders, which has been a concern. So they're buying back some shares to limit the impact of shareholder dilution because of the stock-based compensation. And they still have approximately $787 million on the original authorization of $1.5 billion. So it's likely they will continue buying back shares to reduce the share count. And the rest of the year looks to be shaping strong. They're forecasting, and they increased the forecast to $10.56 billion in revenue, which would represent roughly 22% growth, with operating profit margins of 29% and free cash flow margins of 31%. So excellent news here for ServiceNow stock investors. The company is trading at a forward price to earnings ratio of 43.66, which I think is relatively cheap given the financial performance of the company. Its strong operating margin, free cash flow margin, revenue growth above 20%, in an industry benefiting from rising effectiveness of artificial intelligence. I think those are all excellent metrics. So I've had ServiceNow stock rated as a buy. I last updated that on June 3rd. I'll update this recommendation again on June 13th and reiterate that I still think ServiceNow stock is a buy at current valuations. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.